have to be very clear that we have much better equity buffers and liquidity buffers than we had before, and not everything is the same. It irritates me that this turbulence comes exactly from the same side as the last turbulences. I would have thought at the beginning of the year, if there is another turbulence, it's going to come from the tech side of things, it's going to come from the shadow banking side, and it didn't. So, that always things go back to liquidity is irritating, but it's not the same as it was in 2008 in the global financial crisis.
Andreas, we spent so long talking about too big to fail. And in the wake of the crisis in more recent years, we saw a rollback of some of the regulation about what companies or what banks were considered big enough to attract supervision. That number was taken down effectively, or taken up to 250 billion from 50 billion. Was that the wrong move? Was the rollback of Dodd-Frank the issue here?
There's a long and there's a short answer. The short answer is yes, it was a wrong move. If you know where to look, and the size of a bank is a very important criteria, then you should not water these things down. And I think that a limit of $250 billion in total assets for a bank, considering this to be a small bank and excluding it from net stable funding ratios or liquidity coverage ratios, is a mistake and should not happen. So the supervisors and the regulators, they knew what they were looking for, but if you then don't implement those this knowledge, you are having a problem, and that's what we're seeing. So I think it was clearly a mistake.
Andreas, the problems have been compounded then on this side of the world as we talk about Credit Suisse and the treatment of the AT1s by Swiss regulators, Swiss authorities. This has now stretched across to problems in the wider bond market to CDSs, and those CDSs even involving the likes of Deutsche Bank, very liquid trades here. A small amount of volumes impacted the equity side of some of those major banks here in Europe. As we look at the wash-up of this crisis now for European banks, what would you say that regulators need to do in terms of targeting some of those bond market or debt instruments that we've got here?
Yeah, everybody is looking at CDSs, including myself, but I must say the liquidity of those instruments is very, very low, and it's very hard to really come to a conclusion by only looking at CDSs. If, for example, if you were to look at Deutsche Bank, you would look at how many of those deposits are insured and what is the number which is uninsured, and this is not worrying. You're looking probably to the commercial real estate portfolio, which is not really worrying. You're looking at the derivatives portfolio, which is not changing and not causing too much irritation. So just looking at one element like the CDS prices, which you can really manipulate quite easily with a small amount of money, would be the wrong thing to do. In terms of regulation, you brought up the too big to fail issue. I think this must come back onto the agenda because it clearly is something which is not only a Credit Suisse issue and UBS issue, it is also an issue that there are many, many depositors are putting their money into the likes of JP Morgan and Bank of America, and the too big to fail issue is an issue there too. What I also expect is that regulators will again look at what the Liikanen Commission did think up some years ago, which is a little bit similar to what Vickers did in the United Kingdom. Furthermore, in the EU, many politicians will look towards deposit insurance and to make another run on it. And because it's very clear that smaller countries, Switzerland is a small but a very rich country, but other smaller countries in the EU would not be able to put up all the money to rescue their banks. So deposit insurance is another topic which will come up. Last but not least, the watering down of Basel III has become another topic, and I'm not astonished at all. And politicians as well as regulators and supervisors are looking at this, but the recommendation of the regulators clearly is not to water down Basel III as much as it is now being discussed in the trilogue discussions. So all in all, regulators will have some more things to do. That's the bad news. The good news is that there are many things they can go back to which have been discussed before and can be revisited and can be looked at again.
Andreas, just to come back to the point about deposit insurance, aren't we at risk of compounding an error here ultimately, because we have created a post-crisis architecture that threw up these banks that were too big to fail? Now we are in a situation where, because of the consequences of those, or the risk of the consequences of those failures, the regulators are now being encouraged to extend deposit insurance, which increasingly consolidates the risk further and leads to larger banks. And where's the element of moral hazard in all this?
That is overlooked. The evidence of moral hazard is clearly overlooked. Where is it? And it should be all over the place. And I'm wondering that all of the deposits are insured. If you look towards Silicon Valley Bank, I would have thought that above the $250,000 insurance per account, per person, so to say, per depositor, that you gave 100% to the rest of the deposits. To the uninsured part of the deposits. I would have thought that 90%, for example, would have been totally sufficient. And then if the recovery rate would have been, let's say, 94%, you would have added another 4% and compensated for another 4%. So I thought I was really worried that you go out and guarantee 100% of the deposits straight away because moral hazard really is left very much not being observed, which is a big problem. So I know that there were reasons for helping. Some of the venture capital companies had to pay salaries, but if you would have done a 90%, rather 100% cover of the deposit insurance, then it would have been totally enough, and then you would have you could have had another second look a little bit later. And but again, in a situation of rising interest rates, those interest rate rises won't stop tomorrow, not at all. There is, of course, a worry that there are other banks who have bond portfolios underwater, so that there is some nervousness, and this means that nervous depositors will go forward and put their deposits too big to fail banks, to the very, very large institutions like the ones I just mentioned. And this is something which is especially worrisome in this macroeconomic environment we're in, where interest rates will continue to rise because inflation is far too high. 6% in the US or 8.5% in the Eurozone is far too high. And there has been a suggestion of maybe a temporary deposit insurance while interest rates are rising. My feel about that is, while I see the arguments and the positives, it's easy to introduce something. It's very difficult to get out of it again. So again, moral hazard, I think, should be applied. So your question about moral hazard is right to the point and dead on.
Yeah, I mean, look, we know what happens when you take emergency measures and then they become embedded. I mean, look at the Growth and Stability Pact in Europe at the moment and what the new budget term should look like. But anyway, that's a separate discussion. Just taking you back to the United States for a moment, the regional banks have been a big focus of risk as far as the markets are concerned here. To what extent do you blame Donald Trump for that and the rolling back of some of Dodd-Frank? And should the Americans move very quickly to restore some of those regulations?
It's quite often that politicians get involved. You know, it was President Obama who had this idea of a home for every American, and the subprime sector was developed. It was President Trump who said regulation is bringing all of us down, so we have to change the measurement of when banks are being supervised fully, and he brought up this limit to 250 billion. I fear that many of these political involvements and interventions have, negative effects. So I think very clearly that one of the lessons of Silicon Valley Bank is that we cannot have such a high limit of 250 billion. It does not bring trust to the sector. So regulation should be strict as it was originally envisaged, and it should be brought down again to 50 billion. For example, in Germany, my home country, you also have a small banking box, if you want, where smaller banks have less rigid regulation, but they are not exempt from liquidity coverage ratios or from net stable funding ratios. They just have to report a little less frequent than others because they're very small. But just to exempt a big part of the banking system from supervision and regulation, I find very strange, and it should be really turned back very quickly now.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.